Now the next thing, we just amplified the income. We amplified our holdings. Can we get paid a lot quicker than once a quarter? I got to pay my rent every month. You got to pay your mortgage every month. You got to pay bills every month. How do we control that same asset, same basket of assets, my diversified portfolio, but be able to create a consistent cash flow? The only thing better than an asset that produces one stream of income is that it produces two streams of income. So BMH, do you know what that means? Buy, manage, hold. Wall Street's about buy and hold because they need to keep your money at work. The ordinary investor, the little guy, needs to buy, manage, and hold because we need to get money out of it. We can't wait 10 years to get our money, our investment back. We need to be able to manage that, get our money back, and be able to still maintain that asset. So here's a basket of 5 stocks. Now I picked different ones just to change it up a little bit. This is CVX, MMM, HSBC, Walmart, IBM. This is a 10-year bull run here, comparing this, which is selling covered calls, versus just owning the stock here. So the blue kind of purplish line here is the basket with the covered call. The red is the stock. Now they look pretty hand in hand, right? Because they are. I mean, at times it created more alpha and at times it dipped down a little bit more. But the difference in this owning stock is that you got paid quarterly on the dividend. On our approach, we got paid more often. So what we did here is we did a covered call, and this, we did 45 days to expiration. The other two numbers are, when you're doing this, you're never going to get like the exact 45 days. So you have to have a parameter. These are a parameter here that captures in between. So the idea is 45. The strike that we're looking at is a 15 delta. So for those that aren't familiar, a delta, an out-of-money strike, those are out-of-money calls. 15 delta is the delta of that option. So it's an out-of-money call, it's a 15 delta. The range, 2007 to 2020. So it's 13 years, not 10. Up top there, we got a bunch of numbers here, but I highlighted a few of them. Up top, 8.36%. The strategy win rate, 85%. It's kind of misleading. It's a bull market. But you're told that you can't cap your upside, right? If you sell a call, I'm not going to be able to get my upside. That's wrong. Numbers don't lie. The other part of this is that there's 556 trades. You had 5 stocks. You have to, in a 13-year period, you got to be active. You got to manage. If you want the cash, you got to be a little bit more active. And it's not that difficult, but it is. More engagement creates more cash flow. So this chart here is just isolating stock versus selling a call. So if we just sold the call of these 5 stocks here, the same way, this is what it looked like. This is taking that, capturing that cash flow, or selling the call, capturing that premium, and showing it against here. So even if you just sold the calls, you're right at that $100,000. And sure, you missed up on the upside, but that's different. You're not selling, you're not just owning stock, you're also owning stock and calls, which you get the benefit. So here's this isolating that. The annual rate on just selling that was 0.08%. Another, that's where that 85% rate comes from. But I want to emphasize the fact of you're told that you're limiting your upside when you sell a call, which is incorrect. 731 trades, and the worst monthly return was -2%. It's not bad. I mean, if you just sold calls in an up market where you're told that you can't do it, it's going to put you in bankruptcy, blow your account up. Numbers don't lie. These are numbers. 13 years. You do a long-term time frame to get the right numbers. You don't do short-term time frames to try to back data into it. You make a longer-term data fit what you are looking for. So as I said, covered calls, creating that cash flow on demand. It's pretty easy. We talked about one, doing the margin, using the leverage. Not for everyone. But if you want to get to that 3 million, that's where you have to get to. But the covered calls, we increased it. We created more extra cash flow. Options 1 level approval, pretty easy. More work, sure. but you get paid. You're not waiting quarterly to get paid. You want to get paid as quickly as you possibly can. Selling calls on your asset is the best way. The little nuances on here are you got to be aware of dividend dates, because with the options, you got to be understanding of that. Once you understand it, then you do it. But to be transparent, ex-dividend dates are important. And again, you theoretically limit your upside. Well, the numbers don't lie. The numbers show that you don't theoretically limit your upside.